how do you genuinely stop guessing in the stock market? What if you could take a simple idea, a hypothesis, use AI tools, consumer level stuff, and find companies that did way better than the S&P 500, like more than double?
That is exactly the puzzle, yeah. That's what we're digging into today. We're looking at a specific framework that, historically anyway, generated 22.4% returns.
Wow.
Compare that to the S&P 500's 9%.
Wow.
And that difference, that edge, it came from using tools you probably have up open right now, like on your desktop.
So welcome everyone to this deep dive. We're focusing on these AI-driven investing frameworks. Our mission really is to cut through the hype and show you exactly how tools like, ChatGPT and Google Sheets, things most people can access, can actually run some serious systematic research.
Right. We'll start with the core concept. First, this NFL strategy. Then we'll get into the nitty-gritty, the data filtering, the scoring, and then the really practical bit. We're giving you these deep, multi-layered prompts you can take and use like right away for your own research.
Okay, let's start with the hypothesis itself. NEFL. The big idea seems pretty straightforward. Combine strong business protection with dedicated management. So network effects plus founder-led companies. That's NEFL.
Exactly. And the network effect part, that's what builds the moat, the economic protection. It's that simple idea. The product gets better, more valuable as more people use it.
That distinction is really key, isn't it? Like Visa or MasterCard. Every time a new store accepts the card, it's better for everyone who has the card.
And vice versa.
It's this loop, this self-reinforcing thing that makes it incredibly tough for someone new to just jump in and compete at the same scale.
Yeah, it builds this huge wall around the business.
Yeah.
Protects that market position potentially for, decades. That's the kind of structural advantage you're looking for.
And the second piece, founder-led. That anchors the vision, you said. Why does who's running the show matter so much here?
Well, founders just have more skin in the game, right? They're not just a hired CEO maybe looking at the next quarter's bonus. They actually built the company. They often own a big chunk of it. So they're naturally thinking about the 10-year, the 20-year future, not just hitting the next earnings target.
You think of someone like maybe Mark Zuckerberg at Meta, still driving that long-term vision, even when the market gets noisy in the short term.
Exactly. So the NFL idea is combine that structural defense, the network effect, with that kind of dedicated long-view leadership. That combo should, theoretically, lead to companies that consistently outperform.
Okay, but if these companies have such obvious strengths, these moats and dedicated founders, why doesn't the market just price that in immediately? Why aren't they always expensive?
Well, because the market often misses the nuance. It gets caught up in, short-term stuff.
So that inefficiency, that's the opportunity.
Precisely. And that's where AI becomes this massive time saver. Which brings us to step one, the initial screening.
Right. Instead of spending weeks, maybe months, reading through hundreds of company reports manually, we used a single prompt, just natural language.
Yeah, we basically asked the AI, find me all the S&P 500 companies that have both network effects, A&D, or still founder-led. Simple as that. And boom, it came back with 26 companies instantly. That speed, that efficiency gain, that's the first big win.
Yeah, and I still wrestle with prompt drift myself sometimes, getting the AI to stay on track. But for just raw data gathering, pulling lists based on clear criteria, AI is just fantastic. It saves so much time.
Totally. So then we set up the backtest scenario. Okay, what if we put $100 into each of those 26 companies right when they went public on their IPO date? Total imaginary investment, $2,600.
And then you compare that portfolio's performance against the S&P 500 index over the exact same time frame. It's crucial to note, though, the results are all over the place for individual stocks, right? Like Netflix was astronomical. $100 turned into, what, over 100,000?
Yeah, insane. But then you had others, like Snap, where the $100 actually lost value. And that variance, that really highlights why you need more filtering. You need to go deeper, which is exactly what the broad market often fails to do. So how critical was nailing down that exact historical IPO date data? Was that tough to get right for the backtest accuracy?
Oh, absolutely. Getting that correct historical data is key. Otherwise, the comparison isn't fair. Okay, so that brings us to maybe the most interesting part. Step 2. Adding nuance with this 1 to 10 scoring system. Because like you said, the real world isn't just yes or no for something like network effect.
Exactly. That's a really powerful point. We had to figure out, okay, which companies have a kind of weak, maybe questionable network effect, let's say a 3 or 4, versus those with a truly dominant, almost unbreakable one, a 9 or 10.
And asking for a score, not just a yes-no, that helps with accuracy too, right?
Yeah.
Less risk of the AI just making something up.
That's the thinking, yeah. When you forced it into a binary yes, no, the risk of hallucination, as they call it, seems higher. It might give a confident yes based on weak evidence, but asking for a score like 1 to 10, it forces the AI to weigh different factors to give a more measured judgment. We found that drastically increased the reliability.
And the tool for this wasn't some super expensive finance terminal. It was just Google Sheets add-ons.
Pretty much, yeah. Free add-ons that let you run AI prompts right there in the spreadsheet cells. Super accessible.
Okay, so what did the prompt look like?
It was basically a formula. Tell me on a scale of 1 to 10, how much company name benefits from network effects. 1 is not at all, 10 is very strong network effects. Simple.
Whoa. I mean, just imagine scaling that. Running that kind of analysis across all 500 S&P companies yourself would take forever. But doing it with these tools, that's incredible power for an individual investor.
Yeah, it took about 30 minutes total.
Yeah.
It gave us these detailed ratings for every single S&P 500 company. The cost was maybe $15 in API credits. It's just insane data efficiency.
But hang on, how did you check those scores? How do you know the AI wasn't just, guessing a number? How'd you validate that 1 to 10 data point before you relied on it?
Ah, good question. That's always the challenge with generative AI in finance, right? Validation. We did it by spot checking the extremes. We looked at the companies the AI scored highest, like Visa, Adobe, the obvious ones, and checked that against, consensus expert opinions, financial reports.
Okay.
And then we checked the low scoring ones too. We found the AI was generally pretty good at applying the definitions we gave it in the prompt. It wasn't perfect, but the scores directionally made sense.
Gotcha. Okay, that makes sense. So once you had that reliable scoring, what about steps 3 and 4, building the portfolio tracker app? Was that coding?
Nope, no coding required. That part was mostly about visualizing the data and being able to filter it easily. We used simple prompts in a no-code tool to build a basic web app.
Yeah.
It took maybe, 45 minutes of tweaking with just text commands to get the interface working how we wanted.
Okay, so you've got the scored database, you've got the app to filter it. What was the final cutoff? What did you filter for to get the highest conviction ideas?
We went for the absolute strongest candidates based on the hypothesis. So network effects score between 8 and 10, and founder-led score between 8 and 10. Really stringent. And only 6 companies actually met both of those high bars.
Only 6 out of the original 26.
Out of the whole S&P 500, yeah. Well, out of the 26 initially identified, then scored against the whole 500. It's a very narrow filter.
Right, and the result of focusing just on that top tier, that highest quality slice?
That specific, highly selective portfolio, it returned 22.4% over the backtest period, compared to, remember, 9% for the S&P 500 overall. The key takeaway wasn't just use AI. It was using AI to apply this deep nuance, this scoring, to a simple, clear, testable idea.
That NEFL example really shows the power of thinking systematically. Okay, let's pivot now. Let's talk about how listeners can apply this kind of thinking. Let's share some of those deeper prompts you mentioned, the ones for customizing your own research.
Absolutely.
Yeah.
Because the real value here isn't just copying the NFL strategy. It's about defining your own investment goals and then using AI to handle the complex filtering and constraints.
Sure.
So yeah, we've got 3 pretty powerful multi-layered prompts as examples.
Okay, let's start with prompt 1. This one's focused on value investing, right? Finding cheap cash machines, looking for those hidden gems.
Exactly. We want companies that are just spewing cash. So we did target the top 20% based on free cash flow yield. And for anyone listening, free cash flow yield is basically just how much cash the business generates compared to its stock price. It's a raw measure of cash efficiency.
But just being a cash machine isn't enough. There's a crucial constraint.
Yeah.
The market has to be undervaluing them still.
Yes, that's key. So we add the condition. Their price-to-earnings ratio, the PE, has to be 15% lower than their industry peers. The AI needs to check both things at once. Companies like Qualcomm showed up in those results sometimes.
Yeah.
It works because you're finding that sweet spot, high cash generation and a relatively low valuation.
Okay, cool. Next, prompt 3. Looking for signals from insiders. This is about watching what the execs are doing with their own money.
Right. The prompt tells the AI to scan recent insider trading data, say, the last 90 days. But we're only interested in large open market purchases. That means the executive actively decided to go out and buy stock on the market, not just getting options or grants.
And the amount matters.
Yeah, we set a threshold, like over $100,000,
Yeah.
and focused on key roles, CEO, CFO, the top people. We want significant buys by people who know the business best. We tell the AI to ignore planned sales or stock grants.
Okay, and there's another critical filter here. You only want to see this buying if the stock price has actually gone down over the last 6 months. Why is that combination so potent?
Because think about it. The boss, the person who arguably knows the company's real future prospects better than anyone, is putting down serious cash to buy more stock precisely when the market sentiment is negative and the price has fallen. It's often a strong signal that they believe the current low price is a mistake, that there's value the market isn't seeing.
Interesting. Okay, finally, prompt 10. Finding boring but safe income. This one's tailored for dividend investors looking for reliability.
Yeah, this is all about safety and consistency. We focus the search on typically defensive sectors, utilities, consumer staples, industrials. Then we layer the conditions. They need a solid dividend yield, say, above 3.5%.
Okay.
And crucially, a safe payout ratio, below 70%.
And the payout ratio, just quickly, that's the percentage of the company's profits that it uses to pay the dividend. So lower means more cushion, more safety.
Exactly. A lower payout ratio means they can likely sustain and even grow the dividend, even if earnings dip a bit. And then, the final safety net. We demand a history. They must have increased their dividend for at least 5 straight years.
Right.
Companies like Duke Energy or Coca-Cola often pop up here. It's a very disciplined filter designed to find steady companies that reliably pay and grow their dividends without taking excessive risks.
You know, that kind of systematic approach, looking for specific data points, it also helps find these weird market moments, these anomalies, like that Coinbase trade example you mentioned.
Yeah, that was a classic case of the hidden asset strategy playing out. For a brief window in, I think it was early 2023, Coinbase's total market value, its stock price times shares, was actually lower than the amount of cash and equivalents they reported holding on their balance sheet.
Wait, how does that even happen? How does the market make such a seemingly obvious mistake?
Pure fear, basically. It was the depths of the crypto winter, right? Investors were panicking about everything crypto-related, and that fear just overwhelmed the basic balance sheet math for a while. But systematic research, the kind that specifically flags situations where cash holdings exceed market cap, would have instantly highlighted that. It screamed limited downside risk with potentially huge upside if sentiment just returned to normal. So if we kind of zoom out and tie this all together, this AI-driven approach, it's systematic, it's active, it's definitely not passive index investing, and it's not random guesswork either. The real power is in how you structure your research process.
Right. It starts with having a clear, testable idea, your own conviction. Maybe it's NEFL, maybe it's something else. Like, I believe companies investing heavily in R&D during downturns will win. Whatever it is, make it specific.
Then use the AI tools, like stacking Lego blocks of data, Let the AI do the heavy lifting of gathering the info quickly based on your rules. Don't get bogged down in manual data entry.
And crucially, go beyond just yes-no. Use those scoring systems, like 1 to 10, to capture the nuance. That detail is often where the real edge lies.
And finally, test your ideas. Use historical data to see if your hypothesis actually held water in the past. It doesn't guarantee future results, but it builds confidence.
And it's important to remember, the goal here isn't some magic formula, some get-rich-quick secret that works forever. It can't be. The real goal is making slightly better, more informed decisions consistently over a long period of time. That's how genuine wealth is typically built.
Absolutely. And of course, we have to say, this deep dive is purely for educational purposes. It is definitely not financial advice. And past performance, as we saw even with NEFL, never guarantees future results.
Yeah, and it's worth stressing, if you do use a quality filter like NEFL, that strategy inherently requires patience. You likely need a long time horizon, think 10 years or more, for those kinds of quality factors to really play out. And always, always manage your risk and make sure your overall portfolio is diversified. Don't bet the farm on any single strategy.
For sure. But now you've got the tools, you've seen the framework, you have some powerful prompt examples.
Yeah.
We really hope you feel encouraged to open up your favorite AI tool right now and just test one of these strategies. Start building your own systematic approach today.
Thank you for taking this deep dive with us.